What if I told you that gold prices have surged over 60% in just 1 year, reaching record highs above $4,700 per ounce? And what if the reason behind this isn't just inflation or market volatility, but something far more fundamental, a crisis of trust in the world's reserve currency? Welcome back to my YouTube channel, Calm Invest. Today, we're diving deep into one of the most significant financial shifts of our time, the de-dollarization movement, and why it's sending gold prices to unprecedented levels. If you're an investor trying to understand where markets are heading, or a student learning about the global financial system, this video will change how you think about money, trust, and power in the modern economy. Let's get started. First, let's talk about what's actually happening with gold prices. According to the World Gold Council, the average gold price in December 2025 was $4,290 per troy ounce. That's a staggering 62% increase from $2,644 during the same period the previous year. By early 2026, prices have climbed even higher, touching $4,763 per ounce. To put this in perspective, gold has outperformed tech stocks. Yes, you heard that right, the same tech stocks that have dominated market returns for the past decade. Now, you might be thinking, isn't gold supposed to be a boring, slow-moving asset? Historically, yes, but something unprecedented is happening. Campbell Harvey, a renowned professor at Duke University's Fuqua School of Business and former president of the American Finance Association, has been studying this phenomenon. His research points to one crucial factor. Gold has what economists call inelastic supply. What does that mean? Simply put, when demand for gold suddenly spikes, production cannot keep up. You can't just print more golds like you can print currency. You can't mine it overnight. This supply constraint, combined with surging demand, creates the perfect storm for price increases. But here's the real question. Why is demand surging so dramatically right now? To understand what's happening today, we need to go back to 1944. After World War II, global leaders met in New Breton, Hampshire, and established a new monetary order. Under this agreement, the US dollar became the world's reserve currency, and it was backed by gold. Countries could exchange their dollars for gold at a fixed rate. This system worked for a while because the United States was the dominant economic and military power, and other nations trusted that the US would honor its commitment. But in 1971, President Richard Nixon made a historic decision. He ended the dollar's convertibility to gold. This is known as the Nixon shock. From that moment on, the US dollar became what we call a fiat currency, money that has value not because it's backed by a physical commodity, but because the government says it has value and people trust it. And for over 50 years, that trust held. Countries around the world accumulated US Treasury bonds, essentially IOUs from the US government. They held dollars in their central bank reserves. The entire global financial system was built on faith in the US dollar. But here's where things get interesting and concerning. In February 2022, Russia invaded Ukraine. The US and its allies responded with unprecedented economic sanctions. Among the most dramatic actions, they froze approximately $300 billion of Russia's foreign reserves. Think about that for a moment. Russia had accumulated these reserves, dollars and dollar-denominated assets, as a financial cushion. They believed these assets were safe, that they truly owned them. But overnight, those assets became inaccessible. This sent shockwaves through central banks around the world. Countries began asking a very uncomfortable question. If the US can freeze Russia's reserves, could they freeze ours too? Suddenly, holding US Treasury bonds wasn't just an economic decision anymore. It became a political one. As Campbell Harvey puts it, if your relations with the United States sour, those bonds could become worthless overnight, frozen or seized as an economic warfare weapon. This realization fundamentally changed the calculus for many nations, particularly those that don't have perfectly aligned interests with the United States. China, which has long been accumulating gold, accelerated its purchases. India reduced its US bond holdings. Even traditional US allies started diversifying. The message was clear. Dollar assets are only valuable if you maintain good relations with the United States. But gold is yours, regardless of politics. This brings us to what experts call de-dollarization, the global trend of reducing dependence on the US dollar. Countries are now actively seeking alternatives. Some are exploring common currencies within trading blocs like BRICS. That's Brazil, Russia, India, China, and South Africa, along with several new members. Others are simply buying gold. And the numbers are striking. Central banks bought record amounts of gold in 2024 and 2025. China is currently the largest gold buyer among nations. India's Reserve Bank cut its US bond portfolio by 21%, marking the first annual decline in 4 years. According to Harvey's research, many countries view excessive reliance on the US dollar as inherently risky. They watched what happened to Russia and decided they needed insurance. What's that insurance? Hard assets, things that can't be printed at will, things that can't be frozen by executive order. Gold. Unlike dollar assets sitting in a bank account or treasury bonds registered with the US government, physical gold held in your own vaults is truly yours. It has intrinsic value. It's been a store of wealth for thousands of years. Harvey points out that around 2,500 years ago, during King Nebuchadnezzar's reign in Babylon, 1 ounce of gold could buy 350 loaves of bread. Today, at current gold prices, that works out to about $8 per loaf, roughly what you'd pay at a bakery today. Gold's long-term value retention is undeniable. Now, de-dollarization isn't the only factor driving gold prices, though it's the primary one. Let me walk you through the other key drivers. First, there's the financialization of gold through ETFs, exchange-traded funds. Before gold ETFs launched in 2004, if you wanted to own gold, you had to buy physical coins or bars. You needed secure storage. It was expensive and inconvenient. ETFs changed everything. Suddenly, individual and institutional investors could gain exposure to gold as easily as buying a stock. The SPDR Gold Shares ETF alone holds approximately $140 billion in assets. Global gold ETFs collectively hold 3,932 tons of gold. That's about 38 times South Korea's entire national reserves. Second, there's potential regulatory change on the horizon. Currently, under Basel III banking regulations, gold is not recognized as a reserve asset for commercial banks. This is contradictory. Central banks hold gold, but commercial banks are restricted from doing so. Harvey expects these regulations to change. If banks were allowed to hold just 3% of their reserves in gold, demand would surge dramatically. China has already started this trend, allowing major insurers to hold up to 1% of assets in gold. That translates to about $27.4 billion worth of gold. Third, there are new gold-backed financial products emerging. Gold stablecoins, cryptocurrencies backed by physical gold, are gaining traction. Tether Gold and Pax Gold combined hold about 28 tons of gold. While this is small now, Harvey sees enormous potential. He suggests that if gold tokens continue growing at their current pace, we could see a voluntary return to a gold standard, not imposed by governments, but chosen by consumers and businesses for transactions. Some of you might be thinking, what about Bitcoin? Isn't that supposed to be digital gold? Harvey addresses this directly, and his answer might surprise you. While Bitcoin has some gold-like qualities, limited supply, scarcity, decentralized issuance, Harvey argues that Bitcoin can never truly replace gold. Why? Because Bitcoin has no intrinsic value. It's intangible and exists only on computer networks. The critical risk is what's called a 51% attack, where someone controls over half the blockchain network, enabling theft or unauthorized creation of new Bitcoin. Historically, such attacks seemed unprofitable because crashing Bitcoin's value would negative any gains. But the rise of Bitcoin derivatives markets changed this calculation. Now, large-scale short sellers could profit if Bitcoin's price plummets to zero. This creates a real incentive to attack the network. Can gold's value ever reach zero? No, 7% of gold is used in technology and dentistry, 44% in jewelry. It has real-world uses beyond investment. Gold also doesn't depend on electricity, internet connectivity, or computer networks. In a true crisis scenario, gold remains valuable. Bitcoin might not. So what does all this mean for you as an investor or someone learning about financial markets and economics? First, understand that gold is volatile in the short term. Over 10-year periods, gold shows about 15% annual volatility, similar to the S&P 500. It's not a stable, boring asset anymore, if it ever was. As a short-term inflation hedge, gold actually doesn't work well. Inflation moves 2 to 3% annually, while gold can swing wildly. But over the long term, decades or centuries, gold has reliably maintained its purchasing power. Second, recognize that we're witnessing a historic shift in the global monetary system. The post-World War II order, where the dollar reigned supreme and everyone happily held US bonds, is changing. Not overnight, but unmistakably. Countries are diversifying their reserves. They're buying gold. They're questioning the assumptions that have governed international finance for 75 years. Third, the US national debt now exceeds $38 trillion, well over 100% of GDP. Foreign holders of that debt are getting nervous about America's spending habits and geopolitical risks. As Ray Dalio